All right, everybody. Good morning. Well, today is one of my most fun class, I believe. A lot of people tend to watch this, or at least get some ideas. So the purpose of this conversation is to give you some ideas, right? Because again, with regards to tax deductibility, it's going to be between you and your accountant, if there's any. That could be you also, and then of course the IRS, right? So when you submit your tax returns, it goes through a scanning system. So they scan your tax return. It goes through an AI, okay, um, to see if there's any mistakes. Basically, what they're looking for there is your reported income, right? And then once they have that, then it's up to you to show them what you can deduct, right? And then of course the tax, as long as the calculations, right? So, but let's review what we've learned this week so far, right? So on Monday we learned that as far as property taxes, right? You need to make sure, number one, you know about Proposition 8, which is a temporary reduction on your tax bill. Number two, you understand Proposition 13, which is basically limits the increase of your tax assessment no more than 2% per year on an aggregate basis from the beginning, when the time you bought the property. Number three, Proposition 19, which is makes your tax assessment portable. You can transfer it to multiple times, up to three times in your lifetime, anywhere in California. Remember, these are California rules. Okay. Prop 8, Prop 13, Prop 19 does not apply for other states. Okay. This is only in California. Right. And as we learned, to lower your tax bill or your tax assessment, there are two things that you need to look for. Number one is the most common one is the $7,000 reduction on your as a homeowner exemption. So if you own or occupy a property, you should get a $7,000 deduction from your assessment for that particular primary residence. So as I challenged some of you guys before, send me your address or your client's address and we'll review the tax bill. Because one of the things that we're going to talk about next week on Monday is door knocking scripts, right? Right now, you should be talking to your clients about their tax bill because the second half is due. We know November 1st was the first half was due, delinquent December 10th. Now the second half, which is the February 1st payment, becomes delinquent April 10th. So you don't want to pay that 10% penalty. Plus, for the next upcoming year, because remember the tax year is from July 1st to June 30th of the following year. So it crosses two calendar years. But again, what you want to do is when they see their assessment come around August, September, that's a correct number. But right now it's a good time to be talking to them because they're paying their bills, right? So that's property taxes. Okay. On yesterday, we learned about what do you call that? What are we talking about? Oh yeah, the benefits of owning real estate, right? We learned that what's deductible on your interest is the interest on the only the first $750,000 loan amount when it comes to your personal use homes, and the taxes only the first 10,000 is tax deductible. So I'm sure some of you guys that you pay more than $10,000 in property taxes on your primary. Well, you can only deduct the first 10,000. Okay, it's all computerized, so the system knows that that's what it is. Okay. Then we learn about, you know, if it's an investment property, anything you do with regards to that investment property is tax deductible. Every time you visit it, that trip is tax deductible. So we'll learn about today some other strategies on how to make your real estate life, tax deductible. More importantly, as a real estate agent. Okay, as a real estate agent, and if once you become a real estate investor, you guys will have a lot of deductions. Right? Remember, as I said before, we do things legally, right? Because if we do it illegal, that becomes tax evasion. Tax avoidance is tax deductible. Tax evasion is illegal and will land you in jail and probably have some penalties. Okay. So I'll give you guys the rules. I'll give you guys some ideas that you can talk to your accountant about. And then after that, it's between you and your accountant. Right. So as far as capital gains, we know about Section 121, right? That's the $250,000 exclusion per person, right? You have to live there 2 years out of the last 5 years, right? So those things should be basic knowledge for you guys. Prop 18, I mean, Prop 8, Prop 13, Prop 19, the homeowner exemption. And if you happen to have a disabled veteran, they can get up to $100,000 deduction on their property taxes, right? Now, there are some other exemptions you can have to reduce your property tax bill. For instance, if you have a nonprofit that owns a building, their taxes could be zero, right? Because they're a nonprofit. So, again, there are things that you can do to reduce your property tax bill. You just got to make sure that your client understands on how to read it. So, for you guys, so again, if you have questions, just put it on the chat or you can just raise your hand and I'll call on you. So Gagan, was there a question that you have?
Yeah, I have a question regarding, the capital gain. Let's say you're living in a home, you have that, for husband and wife, it's 500,000 for the primary home, right?
Yes.
Now, I have a case where, they've lived there for more than 2 years and they do have a 500,000 capital gain on the primary home. So
Yeah.
now the husband passed away. So if
Yes.
she gonna sell the home, still she qualifies for the 500,000, correct?
Only if you sell it the year that the person passes away, right? So if let's say you close escrow this year, then the person who is deceased has to file a final tax return, right? Now, if the husband or the spouse passed away last year, right? And then you're
Mm,
selling it this year, okay?
mm,
What happens is you get what we call a step up basis, okay? So when you inherit property, okay, you get a step up basis. So that half gets a step up basis. What that means is the surviving spouse gets 50% stepped up to the current market value at the time of death. Okay. So if they've owned it, 30 years ago, right, the basis is let's say 200,000 for both. So you split that in half. So the husband's 100,000 goes up to whatever the market value is today. So let's say the house is worth 2 million now. Their basis was 200. So his 100,000, okay, the wife inherits $1 million step up basis, not $100,000 basis. Okay? And this works for if kids inherit properties from their parents or grandparents. That is the best way to transfer wealth and avoid capital gain tax is to inherit properties. So my clients, I never tell them to give their properties to their kids or add their kids to title. That has potentially number one, property tax implications, as we know with Prop 19. And then as far as capital gains tax, when you give a property, um, or besides inheriting it, you do not get the step up basis. Okay. So again, that requires tax planning. That's where you need to talk to a tax attorney, or at least have some basic knowledge, so that way you don't have to pay a tax attorney to give you advice that you already know the answer to, right? So in Gagan's question, yes, depending on the year of death, right, to get the full $500,000, you have to be married, filing jointly for that tax year. Okay. Otherwise, it's 250 per person. Okay. And in that case, when someone passes away and the person inherits it, they get a step up basis. Because remember, how do we determine capital gain? It's what we sell it for minus the adjusted cost basis minus expenses equals the net capital gain. And then you deduct any exemption because it's on under Section 121, 250 per person, right? And that will become your taxable gain. Okay, so there's several steps that you have to figure out what is the actual, taxable gain. All right, Gagan. So hopefully that makes sense for everybody. If not, we can answer it later on at the end. Okay, so we know what's deductible as owning real estate interest, only the $750,000 loan amount, 10,000 on property taxes. That's all that's deductible if it's personal use, meaning first home, second home. So because the IRS says that, hey, if you have that much, that many properties, you have, excess income, so to speak, right? And again, this is a nationwide number. And I know in the Bay Area, those get eaten up fairly quickly. So there are talks about increasing that number, right? But we'll see. The current tax law is good until, until this year. Next year, right? They are working on the budget and all that. So next year, they could change the rules and increase that amount. Okay. So for now, we have to abide by the current law. So whatever income you have to this year, whatever happens this year, it's already set in stone, right? But for 2026, it could change, right? So, um, so that's what's deductible. So we understand. So what you want to do if you have a second home is convert it into a rental, either monthly rental, yearly rental, or Airbnb it. Remember, it becomes an investment property if you're in the property less than 15 days out of the year. The moment you go over the 15 days, it now becomes personal use and you lose a lot, if not most of your deduction. All right. So um, so if you have things like that, if you have investment property, my suggestion is convert it into some sort of investment so that way you can deduct most of your expenses. Because remember, the key here is how do we deduct expenses, right? So that's what we've been talking about the last couple of days. Um, okay. So the question here is, what if the property is in the trust, one of the spouses dies? Okay. So if it's in the trust, let's say it's a living trust, I'm assuming that's what it is, an irrevocable living trust, which is very common. Okay. So the trust tells you what's going to happen to that property. All right. Normally, it would automatically transfer to the spouse, right? Okay. So here's the question that I have: what type of trust is it, right? Who's filing the tax returns, right? Again, if it's just a normal trust like most people have, right? The trust is just it's a document, or it just tells you what happens to people's assets, right? So the individuals are still the ones filing tax returns. Okay. So as long as it's the individuals filing tax returns, then you can get that step up basis. Okay. So Saeed, to answer your question, yes. So the surviving spouse can still get a step up basis. Now there are different trusts out there. Okay. So just again, talk to your accountant. Depends on how you're filing to your tax returns. Okay.
Sure.
All right.
May I
So
ask a follow-on question? So
sure.
if it's a LLC, if the
Yeah.
husband and wife
Yep.
form an LLC, especially
Yes.
if they have
Yep.
rental, does it go
Yep.
through the same rule?
No, because remember the LLC is a corporate, right? So you don't get that step up basis. Step up basis only applies to individuals, right? So that's why my rentals are not in an LLC because that's a different tax treatment, right? So again, it's an entity that owns it. Now, if the entity, let's say, remember, I am the beneficiary of that entity, right? Beneficiaries have different treatments. Okay, so if let's say Saeed has an LLC now, right, and he decides to, put it in his personal, name, the LLC is either giving, selling that property, and that has tax consequences, both property taxes and income taxes, and potentially capital gain tax. Okay. So that takes planning. I don't recommend to people, personally, when they say, hey, should I put this on LLC? Me personally, I don't have my investment properties on LLC. Now, if they talk about, oh, I want protection from a corporation standpoint, right? There are other ways to protect your money and your assets besides putting on LLC. To me, it creates a bigger problem for myself. Now, there are instances where setting up as a chapter S corporate, an S corp, some of you guys understand what C corp, S corp is, right? There are benefits to putting an S corp. To me, that's important if you want to put people on payroll and you have enough income you know, um, to run that S corp, right? So again, be careful how you structure your finances, right? Talk to what we call a tax attorney, right? Or a CPA, a certified public accountant. An enrolled agent may know enough knowledge, right? You got to make sure as we talk about some of these ideas, you have an what we call a tax advisor, right? That has knowledge with regards to business owners as realtors. Because if you just go to a normal, let's say H&R Block or these other companies who doesn't deal with people like us, real estate investors, realtors, business owners, they may not know a lot of these, not necessarily hidden deductions, but at least know enough about it. Like I've had clients help their CPA know about how the capital gains tax treatments are, okay? How Section 121 works, or what happens when you move into your property, things like that. So again, there are different things that your accountant may or may not know. So make sure, as I tell my clients, you know, ask your accountant about this idea and tell me what they say, right? Because as far as the things that I'm going to share with you guys, these are things that I do personally, right? And it's going to be up to you to see if that's something that you want to do. Okay, this is not tax advice. This is tax information. Are we clear? Okay, I'm not a CPA. I'm not a tax advisor. I just share ideas, right? Uh, Influencer, maybe not, but again, it's just ideas, right? Okay, so now let's talk about as a realtor, right? As a real estate investor, we talked about that. If you like to go on vacation, right? This is where that gray area comes in, right? If you like to take vacation to Hawaii, right? Think about buying a rental property in Hawaii. Now, because you're going on a research trip for your investment property, that trip can become tax deductible, right? So talk to your accountant about it because you are there to do business. So here's the answer to most of you guys' question is what can I deduct? If it's normal because of your business and necessary, then it can become tax deductible, right? I'm not going to say it is tax deductible because it's how you do it and what was your intent. Okay, I'm planning a family vacation to Hawaii. While I'm there, I look at a couple open houses, call a couple agents, right? That probably is not the tax deductible because your intent was for a vacation. You just happen to do real estate there. No. Your trip is tax deductible if it's a business trip. That means your intent was to do business, to find rental properties, to attend a conference, a convention, a training, right? Your biggest deduction with regards to as a realtor should be your education, your business trips, right? Which is what we call research trips. Those are your two big, and also your marketing expense, right? Those are the most broad that I think I can make it. Everything else should be pretty standard. But to me, that's where you need to take advantage of your marketing and your business trips. Okay. So, of course, your business trips is your education, right? For instance, right now, I'm looking for investment properties in different states, right? I check with our reload department and say, hey, where are people moving to? You can Google that, right? And then I call other realtors first, make some appointments. So my business trip is coming. Now, if I happen to do other personal stuff there, that's okay. My purpose of that business trip um, was, for to create business. Now, why am I looking in Austin, Texas right now? It's for me personally, right? Because as a real estate investor, also I share that information with my clients. Right? Hey, I just happened to, just went to this trip in Austin, Texas. I seen some properties, share that information. Now it's now become part of normal and necessary, right? So again, you can do these things, and the rules that I'm talking about to you guys is applicable to the 50 U.S. states, right? So please know that this is for the U.S. Um, taxes. Okay. All right. Let me just look at the how much is enough income to beneficial to S corp. That's going to depend on you, right? How many employees do you have, right? If you're just single person, you know, I would just do as an individual, right? Unless you have like 3 to 5 employees that you want to draw income every month. Remember, you have to fund that, right? So if you have salaries, you gotta fund that. So you have to have constant income or have enough put in there, right? Just like any business, right? So to me, I would not do it your first or second year, but definitely after your fifth to 10 year, once you're settled, you may want to look at it, especially if you have employees. Okay. Does rent have to be within the country? Yes. Okay. This is applicable only for the U.S. You know, as far as taxes, right? Because we're talking about income, right? Now, with the IRS, right? They said, hey, if you have income outside the U.S., you're supposed to, report and all that. I'm not going to get into that. As far as income and deductions in the 50 states, that's what we're going to be focusing on. Okay. All right. Now, what if I have a conference, because I do a lot of international business because I refer clients there, right? Let's say, for instance, our company belong to a luxury portfolio or the leading RE, right? Sometimes they have out of the country conferences and you want to attend so you can share that information to your clients. That can become tax deductible, right? So on these trips, let's talk about it now, right? In order for the trip to be tax deductible, if it's in the US, you have to work at least 4 hours in a day. Okay, at least 4 hours, right? Okay, if it's international, at least 8 hours. So, okay, so we'll talk more about some things that are that's gonna be not gonna be part of this recording, okay? But I'll give you guys some thoughts, and we'll open it up to just general questions. Okay, so note that if it's business trips, it has to be the intent has to be for business. Okay, if you're going for a Mike Ferry seminar, right? Some of us do Mike Ferry, Tom Ferry, different seminars, right? Anthony Robbins, for mindset, things like that, right? If it's for any training that can be construed for real estate, okay, it's because it's about self improvement, right? So if you have things like that, so if you have any ideas on what kind of training you're thinking about, save it for the end, and we'll do some Q&A on that. I'll give you guys some ideas because again, for training, there's so many training I've taken before that is not specifically for real estate that has been deductible. Okay, all right. So business trips, education. All right, as real estate agents, right? We know that anything that has Intero on it is tax deductible because that's marketing. So how do you make other marketing stuff tax deductible? You just have to put your name and it has to say real estate, Intero, somewhere in there, right? So marketing should be pretty easy. You should never have, personal pens. Your pens should always be business pens. How do you make it business pens? Put your name in it, right? Your realtor, Intero, something that says it's real estate specific, and then just have some all around, right? Same thing with notepads. That's office supplies, right? So anything you do that's real for real estate is tax deductible, right? Or should be, right? So again, what was the intent? Intent means more than 50% of the 50% of the usage is for real estate. We all do open house signs, right? So those are tax deductible. If you put a wrap on your car, as long as it's real estate, right? It's tax deductible. Now we'll talk about how to make your car tax deductible. There's different strategies there, right? So think about marketing. What can you deduct, right? So I see Hema, right? So if Hema wants to make her haircut tax deductible, I'll give you guys some ideas on that. Because again, everyone has like meals, right? We talk about meals, 100% tax deductible right now. They brought it back. Now everyone has to eat 3 times a day, right? So you can't just deduct. Oh, I went to my real estate office today, so my meal is tax deductible. No, you didn't do any real estate business. But I was calling my clients while I was eating lunch, right? No. In order for you to make your meals tax deductible, there has to be number one, has to be in a business setting. So there has to have a table. And the purpose of that lunch is to do business, right? So if you guys have ideas on that, we'll talk about that at the end. Okay. So business meals should be easy to be deductible. But again, don't go overboard on your deductions because if and when you get audited, you need to be able to prove it, right? So with regards to receipts, okay, anything above $75, you must have a formal receipt, right? There are several apps that you can do out there, right? QuickBooks is a good one, right? You take a photo of your receipt. You got to have answer these questions: who, what, where, when, how, and why, right? Who were you with? Where did you go, right? When was it? How much did you pay? Why was it? Why is it tax deductible? Right. So again, you got to have the who, what, where, when, how, and why. How did you pay for it? Was it cash? Was it Visa card? Right. So who, what, where, and how, and why. Right. So with all the receipts, you got it. You got to be able to explain it, and it cannot be on memory. So put it in paper. Put it on your phone. Right. Like I said, QuickBooks is a good tool to use. There, you can do it in other apps. Okay. I'm gonna leave it up to you guys to know that. Right. Okay.
Quick question, bro.
Ratnesh, question
Yeah,
or did you?
yeah,
Okay,
it's
go
a
ahead.
question. So,
Yes.
while you were mentioning QuickBooks, I opened the App Store. There are 6 QuickBooks app. Which one is it? It
What's
says
business owners? right?
QuickBooks Accounting, QuickBooks Workforce. Okay, I'll check that.
No, it's for the accounting, right? It's for the self-employed, right, or the business owners, right? Just like, okay, here's one of the questions: is do I need a full CPA, right? I don't think you really need it, right? You with Quicken, right? Intuit, right? Has, you guys know TurboTax, right? Um, if you know what you're doing, TurboTax is enough, right? Because it's all about the inputting. Now, that can take time. It can take, 2, 3, 4, 5, 10 hours to input if you don't know what to put, right? Here's the thing, right? We can use technology, right? When you input something in a software, right? And you can connect QuickBooks, into TurboTax. Okay, there's an interface, right? So, and as far as other softwares too. So again, it's about what you input. The purpose of having a third party, like a CPA enrolled agent, H&R Block, right, is to help you what you can input and hopefully give you some advice, right, on what you can do, right? But for me, I think for a simple person, unless you have like more than two properties per se, or you have a lot of deductions, or you have a lot of kids, right? You have a HSA, right? You guys know a health savings account, right? Those type of things, or definitely if you have an S corp, yeah, I would definitely hire somebody to do the work, right? What you can do, right? It's early enough now, is for you to, if you have like a couple hours, play around with TurboTax and see if you can duplicate what your previous CPA, or if you like the answers that shows up. Right? It's pretty simple. For me to start with, TurboTax should be enough if you don't mind spending 5 to 10 hours to figure it out. Okay. I've always used an accountant, right? So here's the thing. Because most of all the work that accountant does, that's tax deductible, professional fees. 80 to 90% of what my accountant does is for my rentals and also for the business as a realtor. So that's what we call professional fees. So 90% of his fee is tax deductible because the personal stuff, the 1040 is easy, right? So that's less than 10%. But the other stuff is for business. So again, you can deduct 80% of professional fees, right? That's pretty easy. Okay. Because the purpose of hiring that CPA is for real estate and to run your business as a realtor. Okay. So one question some people have, what if I have, I'm doing real estate part-time and I have a W-2 income from Apple? You still qualify, your 1099 income to have these deductions as a real estate agent. Another question is, what if this is my first year, second year, and I don't have any income for my 1099? Because you're in the business of real estate, okay, talk to your accountant, and the answer should be yes. Some of, if not all your expenses in real estate, you can deduct from your regular W-2 income, okay, because you're in the business of real estate, okay. Because I believe you have to spend at least 50 hours in real estate in a given year. Okay, there's a minimum hours, okay, and that's pretty easy to do, okay. So as a realtor, if you have W-2 income, you can easily deduct it or carry it over to the following year when you think you're going to make more money next year. Okay. So just because you have deductions doesn't mean you have to use it in the year that you spent the money. Okay. Because you can have carryover rules. Okay. Right. For my first year or two, that's what I did. My accountant says, let's save this for next year. Right. So there are ways to lower your income. But again, if you don't have money to pay, or if you think you'd rather use it this year, then your accountant can use those deductions for this year. Okay. Your realtor fees, right? The yearly realtor fees, key fees, right? For our lockbox keys, tax deductible, right? So again, if you guys have anything you're thinking of, put it on the chat or let me know. Okay. So again, check out TurboTax. I think there's another one that's competing with that, and for simple 1040 is free, but you want to get the one for business owners, which is the higher level. Okay, Costco I think sells it for like $99, right? So you get the online version. Do that, okay? It's not the deluxe. It's the highest level one, okay? Because it's for business owners, okay? Same thing with QuickBooks because you want to be able to sort your inputs. But if you know technology, you create your own. Microsoft Access. Any database platform, you can create your own. Okay. There are some other apps out there. So if you guys are thinking of something, let me know. Okay. All right. Let's talk about the car, right? The car is a big thing, right? We all have cars, right? How do you deduct 120% of a car? By having two cars, meaning you deduct 60% each. In order for a car to become a business car, you have to use it more than 50% of the time, unless you're doing the standard the mileage deduction. Okay. The standard mileage deduction, I don't remember the exact number. I think it's like around 60 some odd cents. Let's just say 60 cents per mile, right? So if let's say you're doing real estate part-time, right? You just take whatever business mileage you have, right? That you use for business mileage. We'll talk about that shortly. Whatever your business mileage is, multiplied by the standard rate, let's say 60 cents. You drove 10,000 miles times 60 cents. What's the math? 10,000 times 60 cents is, hello? How
6,000.
much is that? So if Ratnesh drove 10,000 miles, business miles, and it's 60 cents per mile, how much deduction does Ratnesh get?
6,000.
6,000.
You get a $6,000 deduction. So it's as if you didn't make that, right? So remember, a deduction is a it's reduction from your income that gives you an AGI, right? Adjusted gross income. So in this case, Ratnesh gets a $6,000 deduction, right? Is the math right? It's not $600, it's 6,000, right? 10,000 miles times 60 cents.
Yeah, 6,000.
Huh? 6,000. Thank you, George, right? So it's very simple, right? That's standard. Now, if you have an expensive car, if you, let's say you decide to have a S550, right? An expensive car that's, over 60,000, right? To me, that's where the threshold starts, right? When it gets over 50, 60,000, you may want to do what I call the actual, right? Where you have to keep track of your business mileage, right? You keep track of these business mileage the same way. But in this case, you might be able to get a higher deduction, okay? So when you do the actual mileage, you will deduct a portion of your cost of that car, payments, lease payments, right? Things like that. Your gas, right? You keep track of your gas expenses, especially now, right? Gas is it's gone up like, I don't know, $1 more than a couple of months ago, right? And they think it's going to go higher. So the actual gas mileage, right? Or the actual gas expenses, car wash, maintenance, things like that, right? So the things that you could deduct if you do the standard, right? So if we look at that potentially, so if let's say, you have $1,000 monthly payment, right? Thousand, right? Let's say, right? That's if you have $1,000, that's 12,000 per year plus other expenses. It's probably gonna be $15,000, right? Now, if we did the math earlier, right? Ratnesh drove 10,000 miles, right? Okay, he got 60 cents, $6,000, right? Yeah. So to make the math work, in the other case, where it's 15,000 is his total expense, right? His gas probably is going to be more than that, right? More than the $3,000, right? I don't know how much spend you spend in your car for gas. I know I spend, because I use Costco all the time, right? I know I passed the $7,000 limit on my C card, right? So you get that 5% cash back, whatever, right? So I know it's more than $7,000, especially now, right? So if you do the math, right? Let's just say you spent $20,000 on your car expenses. You got to keep track of all your expenses. Remember, you have to use it at least 50% of the time, right? Remember, 50% of the mileage has to be business. What's 50% of 20? Okay, it's 10,000 already. So if I take advantage of that math, depending on what car, okay, it depends. I don't know how many guys are gonna have $1,000 car payment and all that. Then your deduction will be $10,000 instead of the 60,000, 6,000 that we did earlier, because it's a flat fee of 60 cents. Okay, it's in the 60s range. I don't know the exact amount this year, but again, you can just Google that. Okay, standard mileage deduction, right? On your internet, and you'll see what the answer is, right? So in that math, it makes sense to do the actual. It's a lot of work because you have to keep track of your expenses, right? You have to write it down. QuickBooks makes it easy because how you keep track of your mileage, you can do it by hand, right? You have the beginning mileage of the day, beginning mileage, end of the day, how much was business and how much was personal. And you do the math at the end of the year. And in this case, you don't have to do 365 days. The IRS allows you to just take a 90-day snapshot So take 90 days, do the math, multiply by 4, and you get that number for the rest of the year. Okay, are we clear? Now, should you buy, lease? Okay, to me, that's more of a personal choice, right? Um, as far as tax purposes, right? Unless it's a less expensive car, buying it's always best. But if it's a luxury car, I would suggest leasing it. It's the same process. If you buy it, you can deduct the interest. If you're leasing it, there is no interest, right? If you buy the car, you can deduct depreciation, and that's a different schedule. If you lease it, there is no depreciation expense. It's just the payment, right? So again, as far as buying it, selling it, to me, it's more about the payment for you. What's the difference? Now, as far as apps, QuickBooks can keep track of your mileage, right? Mile IQ can keep track of your mileage, or you can just do it manually or on your phone for the day. It's up to you how you keep track of it, right? Okay. Let's see. Anybody have any specific questions on what you can deduct and what have you, right? Again, there's a lot of different strategies, right? You can set up a 529 school for your kids for school in the future, right? So there's other things that you can do. Okay. So any other specific questions before we get to the fun stuff? Okay.
Question, if I may.
Yes.
So
Yes, Saeed.
regarding car payment, if you have properties and you do property management, can you write down also the mileage for that specific property?
Yes. Yep. And remember, is it business related?
Yes.
Yeah. Right. Okay. Now, regards to business miles, commuting miles is not tax deductible. So how do you make it non-commute, right? So once you go into your office, anything you do after that is tax deductible. From the time you come home or when you leave the office to go home, that's commute. So you have to have some commute miles, right? So how do you make your commute miles tax deductible? Well, do some business first. The first stop you have, that's commute. So if let's say Saeed goes from his house to the post office, drops off his daily mail, that stop now is commute. Now his drive from the post office to his main office is now business miles because he already started his business day. So do something business, right? So that way you can start counting your business miles. Okay. So if you have questions about that, we'll talk about it at the end. Same thing at the end of the day. Go visit a client or go door knock, right? From the last door knock to your way home, that's commute. Okay. So some of you guys, maybe the light bulb's coming out. If not, that's okay. Okay. So know the difference between commute and business miles. Okay. You should have a lot of business miles, right? And again, if you have two vehicles, right? How do you deduct 140% of a car? Deduct 70% of each car. So how do you get 70% business miles on each car? That's where you have to keep track. You have to be a little creative, but understand that that's what it is. Okay. So before I look at the rest of the chat, you guys know the president of the United States, right? Do you know what they do when he comes to office? They take all his credit cards. Okay. Anything that he does is tax deductible. Who deducts it? Not the president, but the White House. You know the White House files a return, right? You guys know that, right? All these companies, all these business government agencies, they file tax returns. The city of Union City, the city of Cupertino files tax returns. That's why they have a city manager, right? They have accountants. So we all file tax returns. The only question is, are we nonprofit? Some realtors are nonprofit, so to speak, right? Because they have a lot of expenses and they don't have enough income. Which what I do is we are supposed to be a for-profit business. We need to have more income, right, than expenses, right? But what we want to do is create expenses that generates income for our business, right? So, um, so the question is, yeah. So I answered this: if I have a listing or showing property a few hours from my residence, would using my boat that is close to the properties instead of renting a hotel be deductible? The rent for my boat slip is $500 a month. Okay, all right. Is your boat normal and necessary? Is it used for more than 50% of the time? Answer those questions and you'll have your answer, right? putting making your boat, wrapping it with real estate stuff, right? Number one realtor in the Bay, right? Does that make your boat deductible? Not necessarily, because you have to answer those other questions, right? Is it normal and necessary? Okay. Taking a picture on your boat, tax deductible? No, right? Maybe the time use for that time, or the time use or the cost for that expense to take your boat to the bay and take a picture for your marketing. Now that's a marketing expense. Just like putting a magnetic, sticker or billboard, sign on your car does not make the car tax deductible. The magnetic, sign is tax deductible, but not necessarily the car, right? So again, you have to know that. Remember about the haircut, right? Having a monthly haircut does not make it tax deductible. For ladies, you guys take pictures every year, right? You can prepare for that photo shoot for your marketing. You can now potentially deduct your makeup, your hairstyle, your nails, right? For that photo shoot. And that goes with the guys too, right? I don't know how many guys, paint their nails or, have manicure and all that, right? Anything that you do for that business photo shoot is now tax deductible. When we do staging stuff for our listings, right? We have to, sometimes buy flowers for the open house, buy cookies, have water, right? For our broker tour. Those are all marketing expense, right? So again, with your marketing, is it normal and necessary? So in regards to tax deductions, is it normal and necessary? That's what you really have to look for. Okay. Um, so in case you guys have to jump off, yeah, I'm recording this. I'll post this by tomorrow, and I'll send out the recordings for the last couple of days. Okay. Okay. Client gifts. Gifts are only limited to $25. So if you're gonna gift somebody, you can only deduct $25. Okay. So how do you now make it not a gift? I'll give you guys some ideas on that. Okay, so that's a good thing. Client gifts, right? Closing gifts. Anything that's a gift is $25 limit. So how do you use it as a marketing? We'll chat on that. Okay. So any other general questions before we end the recording and continue our conversation?
So,
Necessary off the recording.
so
So
Greg,
right, Nash?
maybe I missed it, but so you mentioned photography, like photo shoot, is not deductible, right?
What do you mean?
Let's say I take a portfolio picture for myself for marketing. Is it
Yeah.
tax deductible?
That's acceptable because you're going to use the photo for your flyers, right? For your business card, right? For your website. That's
Yes.
tax deductible.
Okay.
Right?
And
Photography.
how about let's say I stitch some suits, business suits would that be the clothing? That will also be tax deductible.
Um, I didn't understand which part. Say it
He's
again,
talking about
Renish.
he's talking about clothing. Like, let's say if you were to actually
Clothes.
purchase a
Oh, like my
suit.
suit.
Yes,
Like my
correct.
suit, right? Oh, I need a
Yes.
suit for the photo shoot, right?
Yeah.
One-time use, right? Right? No, that's because you have to wear that. Now, if it's an integral suit, that's tax deductible because any uniform is tax deductible. But because I have to buy a suit for my photo shoot, that's going to be an iffy. I don't think it's deductible, but talk to your accountant.
Yeah,
Like,
no, not a one time, like forever. Like I
yeah,
use it for
again, yes. It's is it just for real estate, right? How can you, right? So the IRS says uniforms are tax deductible, right?
okay.
So anything that has your name, real estate, real interior, or anything real estate
Makes sense.
can be deductible because that's a uniform. Because everybody gets that. But if you're just gonna buy,
Sorry, Greg, sorry. What if I put the Intero pin on it? Then it becomes.
it has to be permanent. Right?
Yeah, I was about to say that
Okay.
too.
Let's say Bartika wants to do a photo shoot and she wants to buy a Chanel Gucci bag, right? And she puts, her Intero name badge on the Gucci, on the Gucci purse. Is that deductible? No, right? She has to permanently put
What a pity.
Bartika on the Gucci Chanel bag, right? Guys, okay. It has to be for business purpose. Okay, so that's the key. Is this for business purpose? Right? Remember, we can make deductions whatever we want, right? The computer sees marketing, right? When you get audited, right? And if you get audited, will they, see, oh, George spent, George spent $5,000 on his Armani suit for his
Yeah.
photo shoot. He deducted it. the computer, the IRS sees $5,000 as a deduction for marketing. What happens after that? That's going to be up to you. Remember, tax avoidance, tax evasion, right? Lying is tax evasion.
Correct.
Okay. So again, talk to your accountant. This is where your third party comes in. TurboTax has a third party, has advisors also, right? So you can be creative, right? It's going to be up to you, right? So how do you make your real estate underwear tax deductible? Right? There are some, right? So
Put your
we'll
name
talk
on
about that. Right? So put your name on, put your face on it.
Yeah,
Depending
right.
on which side, right? So okay. So again, guys, there are some other things that we can talk about. I'm just gonna stop the recording here. Just remember, it's gonna be up to you what you deduct. It has to be normal or necessary. Okay, it's not and necessary. It's normal or necessary, because sometimes it's not necessary all the time, but because of this instance, it is necessary. Your car breaks down and you're on your way to the appointment. Can you deduct the Uber ride? Yes, because you have to get to your appointment, right? But during your commute, your car breaks down from the house to the office. It breaks down. Is it tax deductible? Probably not, because that's commute, right? So, you're going on a business trip, to go to Mike Ferry this summer. You're going from your house to the airport. That's commute technically, right? Okay, because you have to get to the airport at some point, right? You can have your wife drop you off, right? Things like that, right? So do some business first, and then from your business stop to the airport, it now becomes a business mileage or business trip. So when do you start your business trip? Your business does not start from your house to your office or your first stop, or at the end of the day, your last stop. Okay, are we clear? You have to start your business day and end your business day properly, so that way you can deduct most of your business trips, business mileage. Okay, and this goes the same with regards to your rental property to Hawaii, right? Because if you're going to go to Hawaii to go visit your rental property or to look for rentals, you can deduct your basically from the house, to the airport, because that whole trip is tax deductible. Okay. As far as your business is concerned. Okay. So I'll give you guys some ideas offline shortly. Okay. So anything else? Any other questions I can answer? We're good?
Well, yeah, I have a quick question. So, like, let's say I would actually go to Mexico as a business trip, right? The reason why it's going to be a business trip, yeah, is because I have some clients over there that are looking to purchase properties here in the U.S. So, would that be like, let's say, a business trip?
Okay. Going to meet clients outside the U.S. to get business here in the U.S.
Yes.
Is it normal and necessary?
Well, nah, I don't know.
I mean, let me ask you. It may not be normal, but is it necessary?
Well, physically, you have to be there with
right?
them.
It could be, right? I mean, you can make it necessary. We'll get talking about that shortly. And again, which part of the trip will be tax deductible, right? Anything business related is tax deductible. Just remember that. Yes. Anything business related, you can make it tax deductible. You just have to follow the rules and then survive the audit.
Yeah.
Okay. I've been audited twice and I'm still here. I'm not in jail yet. So we're good. Okay. So again, as long as it's normal and necessary and you have a story to back it up, you have your appointment book to support that you actually went on this trip, you actually went on this appointment, right? Yeah. Those are all helpful stuff. Okay?
Yeah. So another reason why I'm asking is because I have seen, like, let's say I think it's Berkshire or like in Dero, but in Tulum, Mexico, they opened up something over there. So
yep. I've done many international business trips.
Yeah.
All right. So let me hit the stop button here. And this is what we will post.